So you see the headlines, right? You hear the news, but the big question is, are we out of the woods yet with the economy? The Bank of England just dropped its huge November report, and we've boiled it all down to what it actually means for you. Okay, let's get into it.
I mean, it's the question we're all asking, isn't it? After feeling the squeeze for so long, is this battle against high prices finally over?
All right, let's just get right to the numbers. The latest data we have from this new report puts inflation right now at 3.8%. Now look, that is way better than where we were, for sure. But it's still the big problem the Bank of England is staring down.
And why is that a problem? Simple, because it's not this number, 2%. That's the goal. That's the magic number they need to hit before they can declare victory. And that gap, between where we are and where they need to be, well, that's what this is all about. Okay, so before we can really get into what they just decided, we gotta back up a sec. What's their actual job? What's the whole point of the Bank of England anyway? Well, it pretty much boils down to this one thing, that 2% inflation goal.
So their main gig, their entire reason for existing really, is to set something called monetary policy. And honestly, the goal is super straightforward. Keep inflation humming along at that nice, low, stable 2%. That's what they see as the sweet spot, The perfect condition for a healthy economy where businesses can grow and jobs are secure.
Right, so when inflation just went wild, the bank obviously had to do something. And the way they did it, well, think of it like they had to call in the doctor and prescribe some seriously strong medicine.
And what was that medicine? Yep, higher interest rates. The logic here is pretty simple, right? You make it more expensive for people and businesses to borrow money. That cools down spending, a little bit of a cold shower for the whole economy. And when there's less demand for stuff, there's less pressure for prices to keep shooting up. It's the classic textbook move, even if it can be a bit painful to swallow.
And wow, they did not hold back. The bank rate climbed all the way up to a pretty eye-watering 5.25% back in August of last year. But the medicine did start to work. Inflation started to chill out, so they started cutting rates, which brings us to where we are today at 4%. The key thing to remember here is that we're already a long way down from that peak.
But, and this is the huge but, this is where we get to the real problem today. Because the medicine is working, yeah, but it's got some pretty nasty side effects. The bank isn't just fighting inflation anymore. Now they're walking this incredibly shaky economic tightrope.
And yeah, this chart, it shows you that tightrope perfectly. On one hand, you've got inflation coming down to 3.8%. Great, mission accomplished, right? But then you look at the other side. GDP growth, a measure of how the economy's doing, is basically flat, 0.1%. So the medicine worked, but it's also slowed the economy down to a crawl. It's like they're trying to cure the disease without, accidentally harming the patient.
So, that's the dilemma in a nutshell. The Bank of England is basically caught between a rock and a hard place. Two totally different dangers, and both of them are bad.
Which brings us to the two ways they can fall off this tightrope. What are the risks of doing too much versus doing too little?
Okay, so what actually happens if they mess this up? What does it look like if they fall off on one side or the other?
All right, this lays out the two nightmare scenarios perfectly. On one side, the risk is that inflation just sticks around. You know that feeling when your food shop seems to get more expensive every single week? That's what we're talking about. If they cut rates too soon, that's the world we live in. Your money just buys less and less. But on the other side of the tightrope, you've got the risk of weak demand. If they keep rates too high for too long, they could slam the brakes on the economy too hard. And that means businesses struggling and people losing their jobs. So let's dig into that first danger a bit more. Why would inflation get stuck? Well, the bank's report points to a few things. For one, wages are still growing pretty fast. And you've got companies who might be tempted to hike up their prices to get their profits back to where they were. Plus, if some other big shock happens out there in the world, it would hit us way harder while inflation is already high. Now, let's look at the other side of that tightrope, the stalling economy. What does that look like? Well, people are nervous, right? So they're saving more and spending less. The unemployment rate is already ticked up to 4.8%. And if we all keep our wallets closed, that's going to hurt job growth. It could even push inflation below that 2% target. And look, I know that sounds like a good thing, but it's actually a massive warning sign for a really weak economy. So, okay, you've got these two massive risks on either side. What on earth did the committee actually decide to do when they met?
The verdict is in. They did nothing. They held the bank rate steady at 4%. A total pause. But wait, here is where it gets really interesting. This wasn't some easy decision. The vote was 5-4. That is razor thin. You had 5 people saying hold steady, but 4 of them actually wanted to cut rates again. That split tells you everything. It shows you just how uncertain they are. They are completely divided on which danger is the bigger threat right now.
And this quote from their official statement, I mean, it basically says it all. They're saying, okay, the risk of crazy high inflation seems to be fading a bit, and the risk of the economy getting too weak is looking more real. But, and this is the most important part, they finish by saying more evidence is needed on both. They are literally telling us, we don't know for sure yet. We need to wait and see.
So what happens now? What's the game plan? Well, it's pretty simple, really. First, they're just going to watch. They'll be poring over every single piece of economic data that comes out. At the same time, they'll be constantly weighing up those two risks: inflation on one side, recession on the other. And finally, they're only going to make a move, like cutting rates again, when one of those dangers clearly starts to look bigger than the other.
So, to put it simply, they are standing perfectly still. They're frozen on that tightrope, trying to keep their balance, just waiting to see which way the wind starts to blow.
Okay, so that's all the big picture economic stuff. But let's get real for a second. What does any of this mean for you, for me, for our wallets?
And here's the bottom line. The next move on interest rates? Honestly, nobody knows. It is completely up in the air. And that next move is what's going to affect your mortgage, your savings, even how secure your job feels. And all of it, comes down to which of those two big dangers starts to look scarier in the coming months. Is it going to be sticky inflation or a stalling economy? The tightrope walk is far from over.